Hello, I'm Grace. Behind the intense fervor of the stock market, signals are emerging that a massive flow of debt has reached a critical threshold. According to recent market data, the average daily volume of debt-fueled investing has surpassed 62 trillion Korean won, approximately 45 billion USD, breaking all previous records. Looking at the patterns of capital inflow, the scale of credit loans surged by about 400 billion won in just 2 days, confirming an aggressive buying trend. Furthermore, the use of negative accounts, a type of flexible overdraft line of credit commonly used by individuals, increased by approximately 500 billion won, adding a heavy household debt dimension to the trend. This phenomenon shows no signs of slowing down. Instead, it is spreading even as the KOSPI index experiences sharp volatility. Moving beyond a simple improvement in investor sentiment, panic buying, fueled by extreme leverage, is acting as the driving force that maintains the market's downward rigidity. As a result of this capital inflow, securities firms are enjoying an unprecedented boom, reaping massive interest income totaling approximately 1.4 trillion won. However, this contains structural vulnerabilities, as these profits are derived from investors' debt costs rather than their actual investment returns. Compared to previous periods of market overheating, the current scale of debt-fueled investing shows a very high dependence on leverage that exceeds individuals' available assets. As reported, the Bank of Korea has also expressed concerns regarding the potential impact that this excessive, debt-based investment craze could have on the financial system. If market volatility expands, these leveraged funds could become the primary cause of a liquidity trap, exiting the market first and triggering a sudden crash. While the current scale of debt-fueled investing drives market gains, it is simultaneously a sandcastle that could collapse at the slightest shock. The fact that individual investors are mobilizing even their overdraft lines of credit is interpreted as a warning sign that the market's fundamental strength has weakened. Ultimately, the expansion of leverage amplifies market volatility, creating a vicious cycle that leads back to an increased debt burden for investors. It is time to clearly recognize that the current frenzy is closer to quantitative expansion leaning on debt, rather than qualitative growth of the market. As market volatility increases in the future, this record-breaking level of debt is highly likely to become the largest time bomb in the financial market. I'm Grace, thanks for watching.